All right, so this video is going to be on capital budgeting. Capital budgeting is a decision-making approach that is aimed at helping managers make decisions about investments in major capital assets like new facilities, new machinery, new equipment, or R&D type projects. It's a long-term investment decision-making technique. We're going to look at 4 different ways to evaluate investment opportunities. We're going to look at accounting rate of return. We're going to look at payback period. And we're going to look at net present value and internal rate of return. Now, we'll also be looking at profitability index, but that's kind of just a derivation of NPV. So, the way we're going to do this is we're going to look at Crispy Company. Made up scenario, but Crispy Company is the maker of sunscreen. Okay, it's considering an investment in a new machine. Information about the proposed investment follows. So the initial investment, they're going to have to spend $740,000. The machine's going to be useful to them for 6 years. The salvage value of the machine when they're finished, they believe, will be $20,000. And they expect this machine to help them generate annual net income of $48,000. Okay, and their cost of capital is 7%. So we'll get into why we need that and what that is in a minute. To look at the accounting rate of return for this project, it's fairly simple. This is also called the simple rate of return sometimes. And so the accounting rate of return, okay, is calculated like this. Accounting rate of return is equal to net income that you're going to get each year divided by the initial investment. Okay, so in our case here, I'm going to see, that's as small as I can get. Okay, so in our case here, the accounting rate of return would be equal to the 48,000, okay, which is our net income we're supposed to get, divided by the 740,000. Okay, so if we do that, we should get 6.49%. Okay, 6.49%. Now, is that good or bad? Well, it depends on what the company wants. Okay, if the company desires to have an accounting rate of return of a certain amount, okay, we would want to compare this number to what the company desired. Now, accounting rate of return is based on profits, right? It's an accounting number. And so we are looking at how much profit is going to be generated for every dollar that the company invests in this piece of equipment. So we're going to invest $740,000 for every dollar. We're going to get a 6.49% return in profit. Accounting rate of return is pretty easy to calculate. Like I said, sometimes it's called the simple rate of return. But it's not quite the best measure for making these decisions, in my opinion. It looks at profit, and it only compares that number, right, to what we invest. It doesn't take into account how long, okay, over what span of time we are earning, okay, this profit. So we'll talk more about why we need some other measures in a second. Okay. The next one we're going to look at, though, is what's called payback period. Okay. So I'm actually going to build this Excel file over here that I can give to you all. The accounting rate of return, okay, here is equal to the 48,000 divided by the 740,000. Okay. And so if we turn this into a percentage and we move the decimal place a couple times, we're going to get 6.49%. Okay. Payback period is what we're going to look at next. Okay, and the payback period basically says how long is it going to take us to get our money back. Okay, so we're going to erase this here. Okay, how long is it going to take us to get our money back? Okay, payback period. So when we're looking at payback period, Okay. What we're going to do is we're going to take the initial investment. What are we going to spend? And we're going to divide that by the annual net cash flows. Okay. Annual net cash flows generated by this piece of machinery. Now, we don't know that number at this point. Okay, we need to calculate, okay, the annual net cash flows. Okay, we know that this is going to give us a net income, right, of a certain amount. Okay, it's going to give us a net income of $48,000. Okay, but if you remember, net income, right, when we look at revenues minus expenses, we get net income. And one of the expenses that's figured in here is depreciation. So if we know that the net income is going to be $48,000, depreciation has been subtracted from this. And as we know, or as we should know, depreciation is not a cash expense. We spend no money on depreciation. And so what we need to do is we need to take that into consideration here. Now, we're going to simply look at straight line depreciation. So the straight line method, okay, we take the cost of the asset minus the salvage value, and we divide it by the useful life. Okay, so in our situation here, the cost of the asset is $740,000. Salvage is $20,000. And the useful life is 6 years. So if we do this math, we should come out to $720,000 over 6 years, which is $120,000 per year. Okay, $120,000 a year depreciation. So since that's been subtracted from our number over here, okay, to get our net income, to find the annual net cash flows, okay, we are going to take that 48 plus the 120,000. We're going to add back that depreciation, okay, and that's going to give us a number of $168,000. That is our actual positive net cash flow from this machine each year. Okay, so I can go back to my payback period now. Okay, I can go back to my payback period calculation. Okay, and I can calculate. I'm going to spend $740,000. Okay, this should be 168. We just calculated. So, how long is it going to take me to get my money back? Approximately 4.4 years. Okay, after 4.5 years of getting 168,000, I will have made my 740,000 back. So that's payback period. So if we go over here and we put this in, payback period, okay, we are looking at 740,000, and we're going to get 168,000 per year. Okay, that's our payback period. Right, we are looking at a payback period of approximately 4.40. Okay, 4.4 years to get our money back. Now, is this okay for us or not? Well, it depends on what the company says. If the company says we want to have a payback period of 4 years, well, this would be over that amount of time. If the company said we want a payback period within 6 years, then this meets that, right? They would get payback before 6 years goes by. Okay, so payback period and accounting rate of return are pretty easy to do as long as we know what the formula is. Okay, we may have to calculate the annual net cash flows if we are only given the net income, but if we are given the net cash flows, we can simply plug the numbers in. So those two methods, okay, the accounting rate of return and Gotta get my eraser here. The accounting rate of return and the net present value, or the payback period, okay, are two methods that companies can use to determine whether or not an investment opportunity is okay or not, right? Is acceptable. Okay. These two, however, okay, do not take into account. Okay, these two methods here do not take into account what is called the time value of money. Okay, the time value of money. And so we need to talk about what that means. Okay, so I've got another page here where I want to try to go through and discuss this concept, this idea. Okay, if someone invests money today, okay, if somebody invests money today, say they invest $10, and they invest that $10 at an interest rate, we'll just say 4%. Okay, that money is going to grow over those 4 years. Okay, so our time period, number of periods, is 4. We've invested $10 at 4%. Now it's going to grow. Now how it grows is dependent on the kind of interest that the person gets. If they get simple interest, then they're only going to earn 4% on the $10, okay, which interest equals, oops, let's see, I'm having trouble with my pen. Go back to the pen here. Okay, interest equals principal times rate times time, right? So if we invest the $10 at 4% for a whole year, so 12 out of 12 months, okay, we're going to get how much interest? What is 4% of 10? Okay, what would we get if we do that calculation? If we have 4% of 10, right, we get a 40-cent interest return, right? Now, if we have simple interest, that's all we're ever going to get every year. And so we can multiply that times 4 years, right? 40% times 4. And we get $1.60, right? So we would have how much at the end if we had simple interest? Okay, we would have $11.60 by the end of this 4 years. Okay. Now, when we talk about future values, that's what we're talking about. That is a future value. Okay, this was the present value. That's the future value. Okay. Now, problem is, we don't often have simple interest. Okay. Simple interest is not the most common type of interest that you would find. Okay. What we normally find is an interest type that we call compound interest. Okay, compound. Now, the way that works is that in year 1, right, we're going to earn the interest, right? The 10 times the 4, we're going to get the 40 cents, right? But in the second year, we're going to earn interest on 1040, right? We get to earn interest on the amount we invested plus the interest. Okay. So if we do this, we get 1040. Okay, I'm going to punch some numbers here. 1040, and we're going to earn 4%. Okay, in the second year, we're going to earn 42 cents. Okay, and then in the third year, what are we going to do? We're going to earn it on $10.82. We're going to earn 4%. Okay, so in that year, 1082 times 4%, we're going to earn 43 cents. Okay. And then in the fourth year, we're going to earn, oops. Oh, come on, pen. There we go. So in the fourth year, the 1082 plus the 43 that we got in the third year, we're going to be earning interest on $11.25. 4%. We're going to earn how much here? 45 cents. So by the end of this scenario, right, the compound interest, we will have earned, or we will finish with $11.70. Okay, as opposed to $11.60. Okay. So it'd be much better to have compound interest, right? As these periods go forward and as time goes by, right, what's going to happen to the amount of interest that you earn? Right, it's just going to keep going up. 40 cents to 42 to 43 to 45, and so on. Now, these kinds of problems, right, present us with some difficulties if we want to know about amounts that are greater than maybe 3 or 4 periods, right? We don't, at least I wouldn't, want to do a table like this one here for compound interest that has, rows all the way up to, like, say, 40. So we have a different way to go about solving these kinds of problems. Okay? And that's what we're going to look at here next. So I'm going to get rid of this. All of these problems, okay, have 4 basic components. Okay, you have a present value, a future value, an interest rate, and a number of periods, a time for the number of periods. And so if we want to know the future value, okay, of an amount, okay, we can solve that by looking at the present value and multiplying it times a future value factor, okay, for a certain number of periods and a certain interest rate. So in our case, the present value here is 10 bucks. The future value factor is going to be 1 plus, better make sure that looks like a plus sign. Okay, back to the pen here. Okay, 1 plus, goodness, my handwriting is not great with this thing at the moment. Okay, 1 plus the interest rate, okay, to the power of however many number of periods there are. So this is n. Okay, and so in our case here, okay, we have 10 times 1.04. That's the interest rate, and it is for 4 periods. Okay, and that gives us 10 times 1.1698. And it keeps going if you want to go further. 5856. Okay, and if you do that math, you basically get 1170, which is what we just found out before. Okay, so these kinds of formulas are nice because if I want to change this, right, and I want to know what is it going to be if, for example, okay, I am looking at, say, 40 periods instead of 4, right? All I have to do is do the math, and I get here 4.80102, okay? And that basically means over 40 years, that becomes, this amount here becomes $48 and 1 penny, 1 cent, 48.01. Okay, so that's a future value problem. Now, if we don't want to do the math for this, we have also another way to solve these. Okay, that's the same process, but involves a table. So if you look at my Excel file here, This is the future value table. And so you see here in the first column, it's the number of periods, and then there's rates across the top. So for 4% here, going down to 40 periods, right, which is the last one, you see the factor here is 4.8010, okay? And so that factor here, let me highlight it, okay, is the same as what we were looking at over here, okay, when we did the math for this factor, okay? So we can simply look it up in the table like this, which is pretty nice, okay? But there are other kinds of problems that present us with a different scenario, okay? So let's look at one of these. Let's say that somebody promises, okay, to give us $50 4 years from now. And as it turns out, we are able to earn 4% interest on any money that we have. And so what I want to know is, in this scenario, okay, what is this $50 someone's going to give me 4 years from now worth, okay, today? Okay, so we have a future value, and we're trying to find the present value, okay? So how do we do this one? Well, a present value is equal to a future value times a present value factor for a certain number of periods and a certain interest rate. Okay? So in this case, we have $50 times the present value factor. Now, present value factors, okay, look like this. So it's the inverse of future value factors. Now I can do the math for this, okay, or I can go to a table like before. So down here I've got a present value table where the math has already been done. I'm looking at however many periods, which is 4. So I'm here in this row, and I know that it is 4%. So here's my factor. Okay, let me highlight it here. And so I'm going to take this $50 and I'm going to multiply it times 0.854548. Okay, so 0.8548. And if I do that, I get an answer of $42.74. So that $50 3 years from now, or 4 years from now, if I get 4% on my money, is the equivalent of $42.74 today. Okay? That's a present value. But we have other scenarios even still. Okay? And these are the ones we're going to run into mostly in this chapter. Okay? If I have a situation here, we'll just stick with 4 periods. Okay? And someone is going to give me $10 at the end of each of the next 4 years here. Okay, I have a situation where I have equal payments, okay, at equal intervals. Okay, and that, by definition, okay, is what we call an annuity. Now, if we have an annuity, we can do the same kind of thing with a table to figure out what this annuity has, all right, for a value at today's date, okay, the present value, okay. These are all future values, right? These are all future values, and since they are equally spaced and they're equal amounts, we can use an annuity formula. So the present value of an annuity is equal to the payment, or the amount, okay, times the present value factor for an annuity, just like we looked at before. So in our case here, we are going to get a $10 payment at the end of the next 4 years. So we need the factor, okay, the present value factor for an ordinary annuity for 4 periods at 4% interest. And so we'll go, okay, to our Excel file over here where we have a table, and we find the 4 periods, 4%, and we see that the factor here is 3. I lost it now. 6299. Okay, 3.6299. Let me highlight that again. Okay. And so if we do the math, we see the answer is 3629. Okay, or 3630 if we rounded it up. So those 10 payments, or those 4 payments of $10 across those years, assuming that we have 4% interest involved, okay, is equivalent to $36.29 today in present terms. Okay, and that is the present value. These are the kinds of concepts that we have to understand to be able to do the next 2 capital budgeting techniques. So let's take a minute and look at those. I'm going to go back to our capital budgeting sheet here, and we have what is called net present value. Okay. Net present value is the next thing that we're going to look at. So in net present value, okay, we're going to look at the years, okay, and we have, in our case here, 6 years in total, right? Okay, we have a machine that has a 6-year useful life. We are going to look at the cash flows, okay, the future cash flows for this machine. Now, what does that look like? Okay, those future cash flows, okay, over those 6 years. So 1, 2, 3, 4, 5, and 6. Okay. We said we were going to get 168,000, right, each year for those 5 years. Okay. And then at the end, we're going to get $20,000 from the salvage. Okay. So we have 2 calculations to make here. If we want to find the net present value, okay, we need to figure out the present value of the $168,000 annuity that we're going to get, and then we got to figure out the present value of this $20,000 sum. Okay, because in net present value, what we want to look at is the present value of the inflows, and we want to take out the present value of the outflows, okay, to see the difference. That is what we call the net present value, okay, or NPV. So if we're looking at the present value of an annuity of $168,000, we need to know the rate of interest, and we need to know the number of periods. The rate of interest in this case, we are going to use the company's cost of capital, which is 7%. Okay, the cost of capital is the amount, okay, that the company essentially pays to borrow. Okay, if they needed to borrow the money, okay, in order to buy this machinery, this is their cost. And so we hope that this investment returns something more than what it cost them if they had to borrow it, right? If they have to pay 7% for the borrowing to pay for it, then they hope the investment returns more than 7%. Okay, hopefully that makes sense. Now, we are going to then look for the present value factor for an annuity for 6 periods at 7%. And again, we don't want to do the calculation if we don't have to, so we can go to the table. Present value of an annuity, 7%. We go down to 6 periods, okay, and we see that the number is 4.7665. Okay, so we're going to take 168,000 times 4.7665, and if we do the math, we see that this comes out to be 800,000 800,000. I messed up our number here. $800,000 and 772. 800,772. Now, that takes care of the present value of that annuity, but we also need to know the present value of that single sum. So we need to know the present value of the 20 we're going to get in the future. And so we're going to look up the present value factor for 6 periods at 7%, not an annuity, okay, the regular present value, which here we have 7, we're going to go down to 6 periods, and we see that that number is 0.6663. Okay, so 20,000 times 0.6663, and that comes out to 13,000. Oops. I'll get this off of here. Okay, $13,326. Okay. Now, to know the total present value of what's coming in, right, we got to take our 800,772 and the 13,326 and add them together. And we get 800, let me write it over here, $814,098. Okay. So our present value of our inflows, okay, present value of the inflows is 814,098. The present value of the outflows is 740,000. And so the net present value is the difference. And we get a net present value of $74,098. Since the net present value here is positive, we know that this investment returns more than 7%. If it was negative, the return on this investment would be less than 7%, and we would reject it. But since it's more, it means it's an acceptable investment, okay, for the company's parameters. Okay. That is how we do NPV. Okay. We do the present value of the future cash flows, and then we compare that to the present value of the outflows. So the inflows compared to the outflows. Now, I'm going to skip over internal rate of return for the sake of this video, but we can calculate the profitability index fairly easily based on this information. So I'm going to erase some of this. Okay? If we're going to do this profitability index, okay, we calculate the profitability index by taking the present value of the inflows and dividing it by the present value of the outflows. Okay, it's very similar to NPV. So in this case, we would take 814,098 and divide it by the $740,000. Okay, and that's going to give us a number of 1.10. Okay. Now what that means is, since it's greater than 1, that means that the investment is acceptable. If it's less than 1, it means that the investment would not be acceptable. And one of the reasons we do the profitability index is so that we can compare the different projects without looking at the actual dollar values. Okay, we can compare them with this index number to see which one is more profitable, even if it's going to result in fewer NPV dollars. It could be more profitable overall. So looking at our list here, okay, we've looked at NPV, okay, we've looked at how we calculate that, we've looked at profitability index. Okay. And so calculation-wise, okay, you can do this with Excel. Okay, I'm going to highlight the rest of this. By linking in the present value factors, if you have a table, figuring out the present values based on that, and then doing the comparison. My number's a little bit different here just because of the rounding of the factors. Okay, but there's also a way that you can calculate NPV just strictly using Excel. If you hit NPV as a formula, it asks you for a rate, okay, and we can pull 7% here. And then it wants the value. So if I highlight all these values, just the cash flows, okay, it gives me my 814,105.51, which is what I came out with over here. And then I can simply take away the 740 to figure out my NPV. So there is a way to calculate this if you know the future cash flows a little bit quicker, right, than doing all of this stuff that I just showed you. Internal rate of return is where the NPV equals 0. And so you can do a calculation with Excel on that as well. Okay. If you look at this here, if I make sure I get all of this highlighted, okay, I can calculate the internal rate of return. And so I'm going to look at calculating IRR, and it wants me to put in the value, so I put in all the cash flows, and then I have to guess. I have to put in a rate so it can be based on that. And since I know that at 7% the NPV was positive, okay, I'm going to go up the interest rates to figure out where it might go negative. So I'm going to guess that maybe at 12% it's negative. I don't know. Okay. And then what happens is it's going to tell me the rate at which NPV equals 0. Okay. So NPV equals 0 at 10.14%. So if NPV is 0, that means that the amount coming in and the amount going out are exactly the same. Okay. And that is what we would call the internal rate of return. Now, is that okay or not? Well, that depends on the company's basis rate, right? So they want 7% as the minimum, right? That's the cost of capital. This is 10.14, so that would mean that this would be an acceptable investment since it's greater. So this is just an overview of these 4 different metrics and how they work, okay, and how we calculate and make decisions for long-term investments.